continue from where we left. So we left at a point where we started computation of goodwill. I'm aware there are those members who have already left because they are going to work. And I've just said that do not worry, even if you miss the remaining session, because we'll also not take long, you can always catch up. If there is an area you need an explanation, you can always feel free to ask because you will be guided. So in the computation of goodwill, we've already computed the purchase consideration, which I believe all of us remember the steps up to this point. Then we compare the purchase consideration with the net assets of the subsidiary acquired. In so doing, I started by saying I'm bringing on board additional concept that is going to help us to get the value of NCI and the value of retained earnings that we are going to take to the statement of financial position, the group. So that the element I was talking about is to bring the value of the net value of net assets of the subsidiary at the date of acquisition. I want to use the initials DOA, and at the date of reporting, I want to use the initials DOF instead of writing the full words. Date of acquisition and date of financial reporting, or the date of reporting. That's what I was bringing on board. But I told you very well, in the normal computation of goodwill, you do not need the value of the net assets of the subsidiary at the date of financial reporting. When computing goodwill, it is not part of goodwill computation, but you need it to get the value of the NCI and group retained earnings. That's why essentially I'm bringing it on board. So what was the value of ordinary share capital at the date of acquisition? Then the revenue reserves are also there. The revenue reserves are also there. Then we are also going to scout through the additional informations to see if there is any other element that affects the value of net assets of the subsidiary. We are going to check if there is any of them, and we do the adjustments accordingly. All right? So members, ordinary share capital of the subsidiary at the date of acquisition, we get it from the statement of financial position that was provided. So I just come here and I pick it. This 14,400, that's what I'm talking about. Date of acquisition. Do you know the reason why I'm picking on that? I know the date of acquisition was 1st of November 2021 for Solo Limited. The value I've picked is for the ordinary share capital that is given in the statement of financial position prepared at what date? 31st of October 2023. But I've just picked it. I've picked it. And the question is, why am I picking the ordinary share capital at the date of the reporting as the one to represent the one at the date of acquisition? It is very simple. We know the factors affecting the value of ordinary share capital. We know if there is an issue of shares, it affects. But given that this statement was prepared at the end of 31st of October, at 31st of October 2023, if there was any of such events that have happened before, from the date of acquisition to this date here, they must have been taken care of. If not already taken care of, we will get them in the additional informations. So you can scout through the additional information, which we already read, if there was any unrecorded transaction involving share capital, fresh issue or new issue of shares in the subsidiary, if there was bonus issue, rights issue, there was a conversion of a certain category of shares to ordinary shares, there was a buyout, there was a conversion of a loan element to ordinary share capital. If there was any of them, bonus, rights, or any of that, and it was not captured, we will be told by the examiner in the additional information. So far, have not seen. If you've seen, please remind us, let us know. That's why I've just picked on that value to represent the value of ordinary share capital for the subsidiary at the date of acquisition. Now, again, without any mention of those elements that affect the value of ordinary share capital across the year, I will also pick the same value of ordinary share capital to represent the value at the end or at the date of financial reporting. which of course is the same date that this statement was prepared. So if I pick the 14,400 for the date of acquisition from there, that means it is the same as date of financial reporting without adjustment. If there is, we need to adjust. But so far, I don't think there is. All right. Then we come to revenue reserves. Revenue reserves also is given in the statement. And we can see revenue reserves is part of equity. We are looking at the equity elements of the subsidiary. This 26,400. 26,400. This is at the date of what? Date of financial reporting. What date? 31st of October 2023. So date of financial reporting, I'm very sure. I want somebody to tell us, is it the same? Is the revenue reserves the same for the date of acquisition? Is it the same as the one for the date of reporting? Revenue reserves. And I want you to borrow from note 1. What makes up revenue reserves? It is the revenue reserves brought forward or retained earnings. Revenue reserve is the same as retained earnings. Retained earnings that have been brought forward plus whatever profit has been made in the current year, they all are added together and taken to revenue reserves. So that is the element. So tell me, is it the same value as I pick the one for date of financial reporting? Because that one is what is given in the statement here. So I pick revenue reserves for the subsidiary to represent revenue reserves at the date of the financial statement, because that is the date. But for at the date of acquisition, was it the same? It cannot be the same because there were some profits made to form this 26,400. So I see members are talking here. People are talking here. Admin is saying not the same. Nicholas is also saying they're not. Grace, no. Vio, no. Alex, no. No, 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 no. So if it is no, yes, I agree it is no. What is the figure? What is the figure of the revenue reserves at the date of acquisition? Elo is saying 9,600. Thank you, Elo. And I hope members, I hope all of us are able to see where 9,600 is coming from. Look at the statement that we had there in line number 2. We were told the balance on Solos Limited's retained reserves at this date was 9,600 million. You see that figure? That's where we pick it from. So we bring the 9,600 million and say that is the revenue reserves at the date of acquisition, 9,600, like that. Members, I hope we've gotten that difference and the reason and where we've gotten the figure. Then we go to the next element and we are now scouting for any other element that affects the net assets of the subsidiary. And we know them. Somebody remind us, what elements affect the net assets of the subsidiary? Any other element that affects the equity elements of the subsidiary? And I believe you remember how I explained the relationship between net assets and the equity and assets and liabilities. I hope you can relate to what I had explained here. Why I'm calling it net assets.
Mwalimu.
Yes.
Hiyo balance unasema ya revenue reserve iko wapi? Ya retained earnings.
It's given in the second statement, second line from the question. You can see where my cursor is.
Oh, I see. Okay, thank you.
It was given, yes. So I was asking about the adjustments affecting the net assets of the subsidiary. Somebody, what adjustments can we use here? If there was a trading, an upstream transaction, there is an upstream transaction. Upstream means...
Revaluation gain.
Yes?
There's a revaluation gain.
There is revaluation gain, all right? Unrealized profits on the fixed assets, unrealized profit on, is it closing stock? All right. Hello, thank you. So if we look at the equity elements, that is all we have. This is all we have about equity elements, the two of them, but we go to the additional information and look for those elements that also affects the value of the net assets of the subsidiary. So note 1 does not have any. Note 2 was about NCI. Let's look at note 3. Note 3 is about a check of 480 million from Solo to Polo, was not received until 3rd of November. Intercompany balances are included in the accounts receivable and payables as appropriate. Okay. That also does not mention anything about the equity. In October 23, Polo sold goods to Alo for 780. And then there was transfer these were transferred at a markup of 30% on cost. 2/3 of these goods were still in inventory. So this one will be an adjustment on inventory because this is intra-group trading. Then number 5, there was a license that prior to acquisition, Solo applied for some license, a 6-year license to dispose of some waste, and the license was granted by county government at no cost, but Solo estimated that the license was worth 2160 million at the date of acquisition. So that 2160, I wanted to start thinking how it is we are going to use it, how important will it be. Then I want us to look at note 6, where we are told Solo Limited owned an investment property that had a fair value of 1440 in excess. In excess. There was a member who has just talked about revaluation gain. Remember, any revaluation gain, as much as you will capture it under other comprehensive income in the statement, or in the, in the consolidated, not consolidated, but in the income statement, you know that when you transfer to the statement of changes in equity in the published accounts format, you will put that revaluation under the statement of changes in equity, meaning it will affect the equity elements under what? Under revaluation reserve. Members, I hope you remember that step that we did. You will transfer it to the revaluation reserve account, and that revaluation reserve account is under equity. So meaning, in case there is a revaluation, it will affect the equity, which is the net assets of the subsidiary. So there was this fair value adjustment of 1440 above, which was in excess of its net book value. And this value of this property has not changed since acquisition. So since the date of acquisition, it has not changed, but there was that fair value gain. There was that fair value gain. So it was one and it has never changed again, right? So we have to include that fair value adjustment. Fair value adjustment, because it is like revaluation. But because it's an investment, that's why we call it fair value adjustment. If it was a fixed asset, we will call it revaluation. So it was 14. I've seen 1440. I guess I've picked the correct figure. So because it did not change, it will be the same 1440 at the date of acquisition and at the date of reporting, because they said it did not change. It remained the same throughout. So in case there is any UPS arising when the subsidiary sells to the parent, any unrealized profit, then we also need to adjust it here because it will affect, remember that unrealized profit will affect, the value of the equity, the retained earnings. It will affect retained earnings of the subsidiary, and retained earnings will affect, obviously, the revenue reserve. So we will adjust accordingly. In case there is any depreciation undercharge, then we will also adjust it accordingly because it will affect the equity base of the subsidiary. So we are going to scout out for that because we are doing adjustments step by step. So in case there will be, we will adjust. So I will leave some space here and look at the totals. But members, I want you to check on those statements. In case there is something we are leaving out, you speak it out so that we adjust accordingly. Now, with these totals here, remember, we were computing goodwill. I just brought on board this to help us compute NCI and retained earnings at reporting. Now, when computing retained earnings at reporting, when computing your retained earnings at reporting, remember, you are going to check the reason of comparing between the value at the start at the acquisition and the value at the end is for you to get the post-acquisition profit. Post-acquisition profit, the PAP. And how do you get the PAP? You are comparing the net assets at the start with the net assets at the end. That difference will be the post-acquisition profit. In other words, you can call it PAP, post-acquisition profit. Post-acquisition profit. Yes?
I didn't get properly how we calculated the fair value adjustment.
We did not calculate. We picked the value from the additional information number 6. It was given. Are you seeing it?
Thank you.
All right. So that's where we picked it from. Now, I was saying the reason why we are comparing the value of net assets of the subsidiary between the date of acquisition and the date of reporting is to get the profit that they made together after acquisition. Remember, the parent acquires the subsidiary and takes full control. Remember, they have 90%, above 50%. That is full control. So they must have made business together, done business together, and there is some profit that they make. You remember, when preparing published accounts, it is the profit for the year that is being transferred to the, to the equity section under retained earnings. And retained earnings is here under revenue reserves. Members, I hope you're getting it. So, in case there is profit that they made, that profit is already here. So when we compare the value at the date of acquisition and at the end, the difference will represent that profit which they made during the year. So it is that profit that we call post-acquisition profit. So that is the difference between the value at the end at the date of reporting and at the date of acquisition. That in this our case, before any other adjustments, if there is, we are seeing post-acquisition profit is this 16,800. And in the computation of NCI and group retained earnings, we are going to require the parent share of this post-acquisition profit and the NCI share of the same profit, because this profit is made between the parent and the subsidiary. Each of them has a share, has a claim of that profit. Members, I hope you are getting it. They both share into it. So we will ask ourselves, out of that profit, how much of it belongs to the parent and how much of it belongs to NCI? So how do we do it? We are going to look at the share ownership, the ownership percentage. We know that the parent who is now, who acquired this subsidiary, so the parent share of post-acquisition profit will be their share, which is 90%. The parent controls 90%. So it is 90% of what they made. What did they make? The 16,800. So the parent will go home with 15,120. The difference belongs to NCI. NCI. So NCI, we call it NCI share of post-acquisition profit, like that. So the NCI share is the difference. You can either take 10% of the post-acquisition profit or just simply get the difference between the total profit minus what the parent claims to be their share. That difference belongs to this group of people called the NCI. This information from here to here is going to help us in computation of NCI at reporting and retained earnings at reporting. But because we are computing goodwill, let's now get our goodwill because we have everything we need. I hope, members, you are getting what I'm doing here. I'm doing two computations in one. I hope you are getting it. Now, what is the goodwill? Goodwill is the amount over and above what was paid vis-a-vis the net assets acquired. Now, what was paid, we already computed here. Purchase consideration, 42,480. But what did they get in return? They got this total of net assets at the start, at the date of acquisition, which is what? 25,440. So the difference will form what we call the goodwill. So that is the goodwill at acquisition. Sometimes some books will call it an impaired goodwill. You will get that word in some other books. They call it an impaired goodwill. So we now get our goodwill on acquisition. Goodwill. Why is my, okay. Goodwill at acquisition. Some books you'll get them saying an impaired goodwill. So that goodwill is the difference between what was paid in purchase consideration with the fair value of the net assets of the subsidiary at the date of acquisition. This 25,440. The difference is what we call goodwill. Goodwill like that. But again, remember, when computing NCI, when we will be computing NCI and group retained earnings, we need to split this goodwill. Because this goodwill here, I told you we are using the full goodwill method. In full goodwill method, we consider everything at once. Then at the end of it, we now share. We share the goodwill and say, out of this total goodwill, how much belongs to the parent? How much belongs to the NCI? Parent shareholders and NCI shareholders. Members, I hope you are getting it. So that's why we call it full goodwill. It is not one-sided, it is both. It is inclusive. So we come here and say, what percentage of goodwill is proclaimed by the parent? Goodwill for the parent. And then what percentage of that goodwill will now go to NCI because we are going to use that figure to compute our NCI above. The same way, we look at the percentage of ownership. We say if total goodwill is 17,040 and the parent has 90% of it, we multiply 90 by the total goodwill to get what the parent claims out of that. And then we get 10% of that same goodwill to go to NCI. Either you do that or get the difference between total goodwill and that which is being claimed by the parent. That difference belongs to NCI. This figure, we are going to use it. That figure, we're going to use it in computation of NCI at reporting. NCI at reporting. NCI at reporting, like that. NCI at reporting. I'm seeing some chart here. How did we get 17,040? Okay. 17,040 is the goodwill. Goodwill is the difference between purchase consideration and the net assets of the subsidiary. So it is the difference between 42,480. I hope you remember how we got the purchase consideration, this total here. I hope you get it. We compared that with the total net assets of the subsidiary at the date of acquisition. This column here, the 25,440. That difference is what represents goodwill. The total goodwill, that is the total goodwill, Because remember, this is full goodwill method. So that total goodwill is what we've shared between the parent and the NCI. I just hope that we are together. But I think there is something that we need to check, here. There is something that we need to check here. Remember, guys, members, whenever we talk about goodwill, who is acquiring the subsidiary? The person or the company acquiring the subsidiary is the parent. Who is consolidating? The parent. This goodwill is under who? Goodwill is under the parent. So we look at the parent as the person consolidating, the parent company consolidating, and that total goodwill that comes out of, out of this computation. Whenever we are computing goodwill for the parent, we take the 90% of the total goodwill. Yes? But whenever we compute goodwill for NCI, for non-controlling interest, this is a question I'm posing to you. I started by asking you, who is consolidating? Who is the person consolidating? Who realizes the goodwill, the total goodwill? Now, my question to you is, I just want to highlight it, but I'm not changing it. I want you to find out. When computing goodwill for NCI, yes, do we take the 10% ownership of the minority shareholders of the total goodwill, or do we take the 10% ownership of the NCI of the total goodwill of the parent? Do we take the goodwill of the parent, the 10%, or we take the goodwill, the total figure? I'm leaving that question to you, but I'm just picking the one for the total goodwill and leaving it at that, the same 1704. You can either get 10% or get the difference between this and this. The first time I got the difference, this time around I've used 10% when I'm bringing that question because I want your input. Yes, that is a very, very important thing. I want us to look at that. I see two members there saying total goodwill. Thank you. I'll just leave it at that. I'm not changing it intentionally because there is a catch. There is a catch that we are going to check as we move forward. So members, I think it's a good point to stop, and we finish up the remaining tomorrow. We've already talked about a lot. We don't have to hurry. I don't want to hurry to finish it now, because when we hurry, burnout is there. Someone might not understand. So I want us to leave it at that point. Pick it there tomorrow when we are fresh, then we finish. Whatever is remaining is not much. We've done a lot already. We've done a lot. What is remaining is very little. Let's finish the remaining parts tomorrow. Thank you, members. Have a good
Kindly
day.
show you are working hapo juu. Scroll juu kidogo.
Which part?
Hapo kwa nini? Net assets acquired.
Net, okay. In the computation of goodwill, this part? That part? Are you there? Or did I stop sharing? The person who was asking, are you still there? Are you there?
You stopped sharing.
I'm here, sir.